The second test to determine whether something is relevant is the entity test. So the way that works is the information related to this entity and not the owner, which is a separate entity, or maybe another entity owned by the owner, so another business. And what we'll remember is when we did accounting assumptions, this was actually one of our accounting assumptions. So basically what we're saying is accounting entity is an assumption, but it also helps determine whether something is relevant, which is a qualitative characteristic. So you can get the exact same question and just write a slightly different answer depending on whether the question says, can you give me an accounting assumption to tell me whether this should be included? Or can you give me a qualitative characteristic? So it's kind of like a sub-branch of something. If something is relevant, is this accounting assumption called the entity test. Let's have a look at some examples. Mary owns XYZ Limited. So here's Mary as an entity. Remember when we look at entity, we put a box around the entity. Nothing can come in and out. Separate entity Mary to entity B, which is the business XYZ. And this month, she paid her $200 personal phone bill for the month using money from her business. She got her phone bill, but she took the $200 from the bank account of her business. That is not relevant to XYZ Limited. The $200 phone bill is not a relevant expense. It has no impact on the decision making. Well, it shouldn't anyway. So you cannot, pay transactions from one entity with money from another entity. They're separate. But when we're talking about relevance, we just want to say it's all about decision making. This phone bill should not impact the decision making of XYZ Limited because it's for a separate entity. What would that be? We'll look at that later, but basically what we're saying is, look, Mary, if you do want to do that, we're not going to call it an expense called phone bill. You're going to take out your equity in the form of cash, and we're going to call that drawings, but we'll deal with that later, what drawings is specifically. Example number 2. Mary owns 2 businesses, ABC Co. and XYZ Limited. So entity A, ABC, entity B, XYZ. Okay, this time ABC has the phone bill, but it's got no money in its bank account. So she transfers the expense to entity B, in this case XYZ, because it's got lots of money in its bank account. Can you do that? No, it is not relevant. It is not, that $400 phone bill is not a relevant expense for entity B. Shouldn't impact its decision making. It shouldn't have to factor the phone bill for this entity into its decision making because they're separate entities. Example number 3. Let's say Mary owns ABC Co. So same sort of entities here, except we've got the owner and ABC Co. What about this one? Mary is personally wealthy and owns a $2 million property. And entity B here, which is ABC Co., that's going for a loan at the bank. It wants a $500,000 loan, but because it doesn't have very good finances, Mary lists her personal property as an asset of ABC Co. Can you do that? No. Mary's personal assets are not a relevant asset or not relevant to decision making for ABC Co. She shouldn't be included because they are separate entities.